Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guests today are Anthony Moro, Chief Executive Officer, and Ira Miller, Vice President Engineering at Provenance Blockchain, a public layer one blockchain for turning real-world assets into digital assets through collaboration between issuers, investors, and developers. Anthony, Ira, thanks very much for joining us.
Dominic, thanks for having us. It's great to be here.
Okay, but interoperability is more than a feature. It's pretty crucial to the growth of these markets, isn't it? If you've got lots of tokens issued onto different blockchains, the investors are going to want to move easily between them, aren't they? So interoperability is not just an aspect here. It's actually pretty central to growth, is it not?
Very good point. Our contention is there's going to be an oligopoly. Zooming out 10 years, there's going to be an oligopoly of public layer one blockchains that manage and distribute the world's trillions of dollars of financial assets. And I'll kick it over to Ira in just a second to talk a bit about the vision of this. But yeah, from credit cards to custody banks, we see a global oligopoly of financial networks arise because of regulatory pressures and security, and of course, interoperability. So we think those networks will have interoperability solved, and whether it's a bridge or IBC, which the Cosmos network uses and we think is far superior, interoperability will absolutely be a feature. But the future, we don't think, in financial services is 50 chains. I think it's more like 5 or 4 that have the majority of the world's assets, because you just don't need 50. And for that, you also aren't going to be seeing trillions of dollars of assets issued onto what I call the generic blockchains, or those that are purpose-built to be everything for everyone. And the way that you get to those things is you put what I call a Jenga tower of smart contracts on top of a generic protocol to get to a metaverse use case or a meme coin use case or a regulated financial services use case. But I'll let Ira talk a little bit here on that.
Sure. Thanks, Anthony. It is, I think the interoperability desire is really just about accessibility of this technology, right? The Project Guardian example here was saying that if you have these different blockchains or you have these different companies that need to work together, they don't all go directly to a blockchain. They might be starting from their own blockchain, or they might need to work between them. And I think the IBC use case is interesting because it's really talking about the proof of correct operation of the different blockchains, and then how those communications can work between them. And so with Project Guardian, what we were able to do was, starting with the JP Morgan private blockchain, they were able to reach out from that trusted standpoint through a partner called Axelar, which talks between their different blockchains, and show that these different technologies can be interoperable, and that a transaction can start in one blockchain and propagate to another. To Anthony's point about smart contracts, each of these different pieces that you layer on adds complexity, and it adds risk, and it adds sort of this technical debt that you have to maintain and you have to carry forward. And so by focusing on these blockchains that are purpose-built, what we see is that the capabilities required can be unified into that protocol. You can reduce these different friction points and streamline the process. And because you've streamlined it, you reduce risk, you reduce operational complexity, you reduce maintenance complexity. It really makes something that's more maintainable long-term. And I think that is going to be a really important part that we'll see going forward is blockchains specialize in these different use cases. The extra piece that's on this that we don't really talk about is that you really need to take a long-term view on these different technologies. One of the things that we've seen as we've been carrying the Provenance network forward over the last several years is that there is a focus on building brand new shiny blockchains or brand new technology, and not really carrying something forward long term. And so what I see on the technology side is that entities that haven't had to maintain a system long term, that haven't worried about stability, don't really appreciate these decisions that they're making. They don't really appreciate how hard it's going to be to carry something forward with this stack of smart contracts. And I think that we'll see this play out over the next couple of years, this complexity. And it'll be just a drag on some of these other blockchains that are working in that manner.
Ira, can I ask you something else? You heard Anthony refer to these dozens of blockchains proliferating, and they will, over time, collapse or reduce to a complex oligopoly of public chains, which will the vast majority of the business. Something else we see proliferating a lot are what I call fund tokenization engines, sometimes called fund tokenization platforms. I'd put JP Morgan's Onyx platform into that category, for example. HSBC has one called Orion. Began to try and compile a list of these tokenization engines. We found that it would be a very long list indeed. Now, am I right to think that, and to hark back to the fund tokenizations which you've done, I know Anthony referred to digital asset registry technology, but Figure also created this digital fund services platform as well. Does that count as a tokenization engine? And if it does, what's the relationship between the Provenance blockchain and that engine? Do tell me if I'm barking up a tree, but I hope the question makes sense.
It does make sense. I think one of the things to realize is that the blockchain itself, Provenance itself, has these tokenization capabilities, these constraints built into the protocol. But as a blockchain, fundamentally, users interact with applications, and to some extent, they don't necessarily need to understand what's behind it. So in the case of DFS that Figure has built, it's really just showcasing what the protocol can do. And the user doesn't necessarily see the protocol directly. They're working with their application. And so in a lot of these cases, you're talking about these examples, these companies are really trying to show their application, build their relationship with their customers. But underneath, they can and they will eventually streamline behind some of these different blockchains that Anthony is talking about, because the company that's building that relationship with the customer, they want that to be as efficient and as reliable and streamlined as possible. So the engineers that are supporting that customer or in that client, they will actually go and build these things on these blockchains. And so that's where Provenance really excels, is that it does a better job of that than these other kind of platforms we're talking about. DFS is one example. You could build another one on there, and it might look like kind of a competing platform, but in effect, because they're on the same lower level, they are interoperable. They are, it isn't necessarily fracturing the landscape. And I think that as these pieces develop over time, we will see that lower level, through its efficiencies, create an emergent standard for how these assets work and how they kind of evolve and go forward in the industry.
I'll come back to that question of the capabilities of the platform in a minute, because I think it's very interesting, particularly in the context of what Anthony was saying and you were saying about smart contracts. But before I do, there's another area we're working on quite closely at the moment, is trying to understand the digital asset exchange space. And basic questions like what is an exchange are coming up, because the term is being used quite widely by organizations which don't really correspond to what we think of as an exchange, which is a capital raising or secondary market trading place. Now, I see that you are working with organizations which we would probably classify as exchanges. One of them is quite well known to us, Oasis Pro, for example, but you're working with Figure Markets, with Hamsa, with Texture Capital. Now, these are kind of integrating with the Provenance blockchain. What's their thinking and what's your thinking about the contribution that's going to make to the growth and evolution of the tokenized markets?
I'll start with some of the technology side and then hand it back to Anthony. These companies that you're talking about that are integrating with Provenance, what they're finding is that the protocol has settlement features which really streamline this process, right? Anthony had mentioned it early on. We moving from a trilateral to a bilateral settlement. When you're talking about these different exchanges of these assets, these transactions, the features that we're putting in the protocol really streamline and reduce that risk. And so these companies are able to leverage that. A concrete example would be if I have an asset and you are wishing to purchase it, that process on our blockchain, because of the way that the protocol can handle the settlement, I can present something to you, and it can create a hold on that asset within my wallet while I still retain control and benefit. So if that asset was, for example, something that was yield bearing or something that was receiving dividends while we're in negotiation or during the process of arriving at this settlement, I can still be receiving the benefit for it. But while we're in discussion, there's still a hold on it. So I can't, double pledge this thing. On your side, you can actually review the terms of that and maybe offer payment. When we settle, it's directly you and I facing off. There's no third party that's holding these assets. The protocol itself is protecting that exchange. And so those settlement features are really important for an agency or, a group like Oasis Pro that's building on it and handling these assets. And, I think that's going to be something that we see more of, because it is just an efficiency, and it's an efficiency that wouldn't be possible without blockchain technology.
Anthony, did you want to put a commercial spin on that efficiency gain from working with these various markets?
Yeah, I mean, the protocol that Ira built, again, is purpose-built for financial services. It makes us, and having, I spent my career growing up at BNY Mellon. I was there for 22 years. I've sat in more risk committee meetings than you would care to ever sit in your life. And I can tell you that decisions are not made at the C-suite. They're not made by the tokenization group. They're made by the risk committees, because, reputational risk or counterparty risk or cyber risk, I promise you, will derail any project in 5 minutes, and it will never come back to life. So we try to get in front of that, and we try to say safety is our first priority. We sound like we're building automobiles or flying airplanes, but safety is our first priority. And I'll give you a couple of examples. So when Ira mentioned the hold module and the exchange model, when you transact on just about any other blockchain, you put your bid or your ask into a smart contract that you do not own. When you execute, it's executed in yet another smart contract, which you do not own. If you get a dividend or interest, as I was mentioning, it goes technically into those smart contracts. So if the owner of that smart contract goes out of business while he or she has your assets, you're going to have to unwind that in bankruptcy court. Very few people in crypto land are thinking about that. I would also add that we think of our network as a good control location, and that's a very nerdy Wall Street experience phrase, but it's a custody bank or a broker dealer, someone that entrusts that you have control of your assets. And so BNY Mellon and State Street and Northern Trust here in the U.S. are the large custodian banks, and they control trillions upon trillions of dollars of assets in their systems, and they are bulletproof systems. They're always up, they're never down. And if one of those three banks went down during, for 5 hours during a trading day, the stock price gets, cut in half, right? Because they're not fulfilling their mission. Blockchains, the larger public layer one blockchains go down, seemingly all the time, and their token prices don't ever take a hit, right? Sometimes they even go up, which just tells me that, and I'm not throwing shade, it just tells me that no one is thinking of them as a good control location for financial services. So when their market is in turmoil and you want to get largely out of your asset, right? Market's in free fall, I want to sell, but my network's down for 5 hours. And when the network wakes up, my price is down 20%. What's the recourse, right? And they're in a public blockchain scenario, there is no recourse. In the Wall Street world, if BNY Mellon's down for 5 hours, you can't get your assets out. I can assure you there'll be a lawsuit. So we try to think of ourselves as a good control location where we're always up, we're never down. Our network is as protected as a public layer one can be, and Ira can expand on that if you need him to. But being built for financial services means exactly that. You're not going to see, the metaverse on Provenance. You're not going to see, the latest meme coin trend on Provenance. You're not going to see gaming on Provenance, because all that are great use cases for other blockchains, but they congest the network. They interject risks that our users are not, willing to take. And yeah, there does need to be a very professional financial service oriented blockchain or blockchains that I think will come to dominate the space.
Now, there's a risk that I'm going to stray far outside my comfort zone here, but I think from everything you've been saying, it's quite important to understand the technical aspects of the provenance blockchain. So if I start by saying, as you've said more than once, this is purpose-built for financial services. As I think you've said, one of the risks you've identified in alternative blockchain solutions is the smart contract. What if the smart contract falls over when it's actually holding your assets? Good luck, litigating that. If I understood your model correctly, you're looking to dispense with smart contracts. You're looking to build the specialist financial services capabilities directly into the platform, the settlement, the asset servicing, and so on. So you're not using smart contracts, you're actually building this stuff into the protocol. I wonder, is that a risky approach in the sense that the imagination of potential issuers is potentially boundless? People are going to come up with all sorts of assets and asset features which are really difficult to predict. So how do you, if I've understood your model correctly, and I'm assuming it kind of reduces the flexibility a bit, is there a risk that you won't be able to meet the satisfy the imagination of all these investment bankers and other entrepreneurs are going to be coming up with all sorts of clever ways of creating digital assets because you're skeptical about the risks associated with smart contracts? That was a question for Ira, I guess.
I think there's actually there's nuance here and complexity. So Provenance does support smart contracts, and we do use them, and they get used in specific areas. But when you're trying to decide, well, when does a smart contract make sense, and when should something be done in the protocol, you parse that statement very carefully, like Anthony mentioned, based on risk and who's responsible and when are you introducing a third party. If you're not introducing a third party, if you're talking about maybe some special water flow or waterfall calculations and it's all owned by the entity that you're transacting with, in those cases, it might make sense to use a smart contract. If you're, as you alluded to, if you're talking about sort of emerging functionality or something that's new and cutting edge, and it may or may not be the direction that the overall protocol wants to go, or maybe it doesn't know if it wants to go there yet, smart contract is great because it allows you to rapidly prototype and prove out that something is a legitimate direction for the protocol. And so from an engineering standpoint, we like to leverage those smart contract capabilities as sort of that leading front in terms of, we might implement or prototype or test out some sort of new capability using a smart contract. And then if it proves effective or we fully understand the problem, we'll fold that functionality back into the protocol when it makes sense. And so I think, in both cases, in terms of being able to explore rapidly directions things might go, as well as allowing, different entities on the blockchain to enhance their capabilities through smart contracts, yes, we would support those things. But we believe firmly that certain aspects that are common, that are well understood in terms of different parts of tokenization and settlement and things, since those are common rails, they make sense to have in the protocol to be de-risked and to be optimized. I think one of the things that is a constant challenge for an engineer who's working in a smart contract is that they are very limited. There is not a lot of data processing that they can do. They're less efficient than something done in a protocol. And so you have to be very strategic and very careful about how much you do in one, or you'll run out of resources to execute that transaction and your transactions will fail. So I think that, it is complicated, but there are a couple of paths forward there from a technology perspective.
Just on a narrow scale, this term marker, which I see you use, is that just a term you use for those functionalities? You're either building into the protocol, or which maybe began life as a smart contract and are later built into the protocol when they've sort of proved themselves? Or does marker mean something completely different? And where did you get this idea from anyway? What the term marker?
So marker was a term that I chose back when I was trying to develop something that basically represented the management and organization structure for a token. So the reason why we didn't just use token is because a token has kind of a well-defined meaning of these innumerable coins, basically, or something that you'd see in another network. But what it doesn't encompass necessarily is a specific set of permissions for who's allowed to mint and burn and transfer authority and things along those natures. So we needed a new term that described, what is that thing that encompasses that organization. And so a marker makes a lot of sense. It's something like you might use in golf to put down on the ground to say, this is a point, that I'm going to be working from. It's related to token, but it's not the same thing. So you don't end up with that kind of overload. On our network, a marker has a lot of capabilities, and it's all centered around management of that token. You can do things like mint or burn, or have a fixed forever unit of token supply. You can define in a very precise way the transfer authority that's associated with the token. So we can define something that the users can hold and own, and they own it completely. They have self-custody over that asset, and yet they can't necessarily transfer it to another entity without kind of an advanced set of token authority that goes along with it. So I think there's a lot to it, but that's what that term is for.
Understood. Now, this may be a stupid question, but I'm going to ask it anyway. One of the reasons I got very excited when I first read about the Provenance blockchain was that it was public, that it was open. So it fitted with my personal vision here of lots of developers coming to an infrastructure and writing code, which gradually adds to the functionality and richness of the infrastructure, enables newcomers to compose those bits of open source code into new products. And this is how the token markets are going to grow, because you've got lots of people working in a standardized way, creating bits and pieces, the Lego blocks, as they say, which can be built into entirely new products and services. My question is this: if you are building a lot of stuff at the protocol level, is that bad news for those entrepreneurial developers who come along, or is it good news for them? In other words, does your model encourage contributions to the development of the blockchain by these independent developers, or does it inhibit it?
I would say that it kind of it clarifies the way that participation would work, perhaps. So stepping back, if you look at what Provenance is and how it works, there's a lot of open source technology that's involved. We're based on the original Tendermint, now called Comet, consensus algorithm for routing blocks and structuring blocks. We're also using the Cosmos SDK, which is another very large open source effort that kind of standardizes the way a lot of pieces work. And then when you get, and so both of those efforts have numerous engineers all over the world, and they're kind of a foundation of a lot of different products and a lot of different blockchains out there. When you get to actually the provenance code, it's really that specialization, that narrow refinement for those financial services use cases. And so by definition, that specialization and that refinement is a smaller community, but it is still open source. It's still built in the open on GitHub, and any of these other engineers that wanted to participate can choose which level of participation. Are they more of a generalist and they're working in sort of the Tendermint consensus layer, or are they a little bit more focused on sort of the blockchain concepts and they're working in the Cosmos SDK layer, and maybe they're participating and making contributions, for example, to like the bank or accounting modules, which are used by a lot of different blockchains. There's people that's the interest that they have. When they get down to the very precise refinements we're talking about for financial institutions, they might be contributing or auditing the provenance source code directly, which is layered on top of all of those things. And so I think there are a lot of different layers, and it just kind of depends on what type of an engineer and what type of focus you're interested in.
You mentioned Cosmos. What was the logic of choosing Cosmos? Why pick Cosmos?
So that was a really interesting time. This is back in about 2020 within Figure, when I was working with the blockchain there. Figure actually started with Hyperledger Fabric, and you have to understand the context. Figure being a startup, being able to rapidly innovate and go in different directions when it makes sense. What we were finding when we started with Hyperledger Fabric is there was a lot of friction in the operational space. It was really difficult to get, as a private permission network, is really difficult to scale the participants, to get access to different technology and pull in sort of the larger ecosystem. And so at that time, facing these frictions, I looked around and I said, okay, well, how can we benefit from the larger open source ecosystem? How can we benefit from the ways that we're seeing this stuff evolve, the sort of the work hardening, the refinement of these tools that we're seeing with a lot of different, large developer communities, but still retain that ability to precisely focus on the needs that, the business use cases that Figure was driving. And so as part of that wide canvas of a lot of different protocols, a lot of different technology that was out there, the Cosmos SDK emerged because of their original ethos, which was the Internet of blockchains. They recognized early on that supporting interoperability, the ability for different blockchains to communicate safely and reliably with each other, just like the nodes on the internet communicate with each other, was going to be really important. My background in sort of research and distributed systems and things, I recognize that the kind of some of the tenets that they had there were going to be really important. I also was impressed with sort of the high quality of their initial engineering, the type of people working on the project, and their commitment to excellence was also really high. And so that was a reason we selected it at the time. We did a comparison. We looked at the operational complexity. It had massive benefits there. We thought the community was strong. And so it was a really good move to basically say, hey, I'm sorry, the work that we've done over the last 2 years, we've learned a lot. We need to go this other direction for various reasons. And we ultimately pivoted into that direction for a public layer one built on the Cosmos SDK.
You mentioned the consensus algorithm you've chosen as well. Now, the Provenance blockchain is a proof of stake blockchain. And one of the challenges that sets for you is you have to keep enough validators excited to process all the transactions which you're going to be hosting. Is that a challenge for you? And if so, how do you keep the number of validators sufficient to process what needs to be processed?
So it is a significant challenge. It's also a significant challenge based on the economic model that Provenance uses. So one of the things that we were strongly trying to avoid was sort of the hype-based economy that you see with a lot of ICOs, where you end up with a kind of a very inflationary token that has a lot of speculation and a lot of kind of retail focus. We wanted something that was based on fundamentals. And so as part of that, the utility token that powers the staking and sort of the gas transactions of the network does not use inflation, which means that the fee revenue that validators can earn is based on the use of the network. Literally, the utility of the network pays for the network. And so that does put a kind of an upper bound on things. You don't have that easy lever to pull where you're, basically devaluing stake that's not participating and transferring that value to the validators. You're only using these fees. And so, I guess from that standpoint, the size of the validator network and the size of that community is directly proportional to how much the network is used. And so if we use the network more and we pay more fees, then it supports more validators. And so we've found a balance point based on the current workloads and the current utilization of the network with our current set of validators. And I think, as these new applications grow, both from kind of the Provenance and the future Prov labs, as well as, figure markets and some of these things, as those grow, the validator set will also grow to reflect that.
Now, I thought I'd seen it all in blockchain, but as I was looking through your documentation, I came across a new term, which is, and forgive me if I should have named this, but a layer 0, as well as a layer 1 and a layer 2. Can you explain what a layer 0 is?
Well, I mean, layer 0 is actually there's a company named layer 0. Layer 1 is what we think of ourselves as the Provenance blockchain itself. I don't know if you'd want to expand on that further. Anthony, you want to talk about that?
I mean, I think some people might consider Cosmos as a layer 0. It's a layer upon which you build. Avalanche also I've heard of being thought of as a layer 0, and then you build the C chain or the other chains on top of it as layer 1s. It's I mean, none of these, what I find infuriating about the crypto industry is the definitions are fast and loose. An exchange is not an exchange. A symbol is not a symbol. A layer 0, layer 1 is ambiguous for sure.
Understood. Does that, talking a bit of terms used, is your term zones, is that the same thing as a node, what we used to call a node? And if I'm right about that, are your users, your owners operating them, or do you have to do it for them?
So a zone actually, it comes out of the Cosmos SDK based chain ecosystem. So when they were proving their interoperability between blockchains, they had this contest called Map of Zones, and it was really these different blockchains. Each blockchain was a zone in that model. We've leveraged that a little bit further in a little bit different direction within Provenance, because we have our mainnet, which is sort of the standard public layer 1. Technically, that's a zone, also in kind of the Cosmos SDK world parlance. But we also have this concept that we will offer a private zone, which is something that makes sense in financial services. And literally, it is an instance of the Provenance blockchain protocol, but operated entirely by an entity. Typically, it could be used publicly, but generally, that's going to be a full private intranet type application where that entity may want to ledger a bunch of extra information that they wouldn't want to disclose publicly. So they might ledger like a full cap table or something privately, and then selectively participate in the public layer 1. It also provides a kind of an on-ramp for companies that wish to get started, but they don't necessarily have the regulatory clarity, or maybe they've got regulatory restrictions that prevent them from working with a public layer 1. But they want to be positioned well for that, because the future definitely seems to be towards a public layer 1. So they can build a private zone using the exact same tools and things on the private network, and then seamlessly transition to our public mainnet layer 1.
And JP Morgan used that exact setup in a private zone for their Project Guardian. So they use their ODA, which is a private network, a private instance of Avalanche, and a private instance of Provenance. And that's where the interoperability went with the bridges.
One last technical question. You've issued a utility token called Hash. What do you need that for?
So the Hash token literally is our staking token. It's the utility token that the network uses, and it's important because you need something like this to have a little bit of independence, but still retain kind of a common way to pay for all of the transactions. So case in point, if you're doing settlement, you might be paying fees on that settlement. You would pay those fees in our Hash token, which allows kind of a common fee payment for gas, for any of these assessed value of settlement. It also is the same thing that you would use to stake in the network. It represents your interest. It's something that's used as part of a proof of stake network for basically putting the weight and the value behind the votes for validators in the network, which that basically is meaning that the more of the stake you have in the network, the more weight that you carry in the votes for blocks and for transactions and for governance. Yeah, that's the hash token.
Since you brought up settlement, Ira, the term I see on your website again is deterministic finality. I'm just wondering if that is different from settlement finality. Here in Europe, we have endless theological debates about whether atomic settlement achieves settlement finality, because settlement finality is a legal term. It's actually defined in a settlement finality directive of the European Union. What do you mean by deterministic finality? Is that just your term for atomic, or does it mean something different?
So it's actually, in this case, at least from my perspective, it's very specific to a technical concept related to blockchains. So there's two main types of finality in a blockchain. You have deterministic and you have probabilistic finality. One of the things that's really important about the way that provenance works is it basically goes all in on being deterministic and having safe and reliable ledgering of transactions. And by that, I mean that it's impossible for our network to fork. It's impossible for there not be consensus when a transaction is included in a block. And if a transaction is in a block, it has achieved full consensus and it has achieved deterministic execution. So from a technical perspective, it's a really important bar to meet. It means that as soon as a block is cut, all of the transactions in it are completely certified and valid, which, given our block time between 4 and 5 seconds, each of those transactions at that point can be trusted completely throughout the network. Whereas if you were a network, say like Ethereum, where you have the possibility to fork, or Bitcoin is kind of like one of the standard originals, you need to wait 10, 15 minutes with many subsequent blocks to be cut to ensure with some degree of increasing confidence that that transaction was properly executed and can't be rolled back.
Just a couple of final questions for you. One which I must ask, we've touched on this earlier, interoperability between blockchain protocols. When you refer to interoperability in the long-term vision of where this industry is going to go, does it mean interoperability between all blockchain protocols that might exist? I know Anthony referred earlier to an oligopoly of these things, but in the short term, medium term, we're going to have lots of these things. Are you talking purely about interoperability between blockchain protocols, or are you, having talked about digital twins, so assets are going to continue to exist in their analog form, so there's got to be interoperability between the blockchains and traditional financial markets as well? And what's your view of how this interoperability is going to work? So how extensive is it? Does it cover traditional as well as blockchain digital assets? And how's it going to work? Do we need standards? Is it just a question of writing some new pieces of protocol? What's the solution in the end to the interoperability problem?
So I think that the solution is still something that's coming. When we talk about interoperability between blockchains, we can start at sort of the ground floor and say, can these two things talk to each other? It's sort of like, when do you have an internet of blockchains? Well, you first step is you need to run the wires and literally get these things connected. And then as that base layer is achieved, you can layer more things on top of it. I think as a larger industry, there's a lot of people who focused on getting the initial connectivity there. And I think there's a lot of different solutions out there taking that from a lot of different directions. On top of that, the easiest thing to solve was to transfer token representation, fungible or non-fungible token representation between chains. And so we've seen that relatively kind of mature as something. What I think is still coming, what I think is going to be a lot harder to solve, are the more complex assets that you'll see in the financial services world. So it's not enough to just move a token. Some tokens have, as I alluded to before, kind of a transfer agent involved that approves transfers, that maybe sets concentration limits on ownership, that vets different clients. it's not just enough to move the representation. You have these rules to go with it. And I think that's something that we're still seeing evolve. It hasn't necessarily established exactly the best way to do it. We've seen some implementations where you might have a contract representation on multiple chains, and the actual act of moving the asset doesn't really move the asset. It moves a request to move the asset, and that kind of balances out between. So that's sort of emerging. But along that same line, even more complicated, and what will take even longer to represent, is when you're talking about a digital asset that's a little bit more complicated. So something like a HELOC that is you'll see on the Provenance blockchain, it's not enough to have just the token that represents the HELOC. You have potentially the whole asset perfection piece that's behind it. So you've got liens, and you've got documentation, and you've got a whole bunch of data which lives off chain and some that lives on chain. And so for something like that to move between blockchains is going to be orders of magnitude more difficult. And I think that the industry is still coming to terms with exactly what that means, how much of the asset needs to move. Can it just live in its kind of originating inception point, and then some sort of a pseudo representation, be exported? The ideas and the technology is being explored, like we talked about early on. Project Guardian, one of the things they wanted to show was, hey, this asset lives on this blockchain, so we'll talk to that blockchain to do a common operation, but we're not going to move that asset out of that chain somewhere else. We'll just reach out and do something with it in that network. And so in that case, interoperability is a little bit easier to achieve because it's just moving an intention. It's not moving the asset. And yeah, I think that as the industry evolves, we'll find that balance point, between moving things seamlessly, between moving intentions, moving, partial representations. We'll find the answer, but it'll take some time to see what works and what works well.
Well, I think we should probably leave it there, though I would happily continue this conversation for many hours more. It's been absolutely fascinating. But thank you, Anthony Moro, Ira Miller from the Provenance Blockchain, for taking the time to share all your knowledge and experience with the members of Future of Finance. Thank you very much.
Thanks for having us.
Thank you.